Welcome to Daily Fortune, where we talk about the latest topic about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so that you'll know when I upload new videos. Now, let's get started. Almost everyone has been warning about the impending inflation in recent months. Inflation has begun to rise in basically all goods and services, and this was already seen by the greatest investors like Ray Dalio, Michael Burry, Warren Buffett, and even people around the world. Furthermore, the vast majority of investors expect that inflation will continue to climb, but Cathie Wood believes in the opposite. She believes that the reverse will occur, and it is deflation, not inflation. The world has prepared for inflation, but Cathie sees a deflationary crisis as an unpredictable event. For today's video, we will know why Cathie Wood believes this and how the data will support her claims. So, let's get started. Cathie Wood, who started her career as an economist, can back up all her statements because of her decades of experience. Regardless of the previous perception of anyone, it's still very important to consider and hear what Cathie has to say. Going back to 1980, two well-known economists, Henry Kaufman and Milton Friedman, believed that inflation was here to stay. But Cathie Wood, on the other hand, a relatively fresh and new economist, believed that inflation was slowing. In the end, it's not unexpected that Cathie Wood is making her bold prediction against the majority right now. The money supply is the first indicator of decelerating inflation. Since the start of the pandemic, the supply of M2 money has tremendously increased. Savings deposits, checks, cash, checkable deposits, money market funds, and certificates of deposit are all included in the M2 money measure of the U.S. money supply. It's no surprise that M2 money has risen considerably in response to the growth in stimulus checks. Cathie Wood, on the other side, has noticed a trend that M2 money growth is slowing rapidly. Money growth in M2 has decreased this year from 27% in April to barely 17% in May. The bond market has been surging in recent months as a result of the slowdown in growth. After peaking at 1.7% in March, 10-year Treasury bond yields have been reduced to below 1.5%. Because bond yields and prices are inversely interrelated, the bond market has been surging as yields have decreased. When this occurs, we can assume that the bond market is expecting deflation rather than inflation.
The bond market could be rallying because of what I just mentioned about money growth. I don't think many economists have observed, I haven't seen it at least, that the money growth rate has been cut in half from that 27% to 13.8%. Maybe the bond market is focused on that.
Maybe you think that the bond market has been rallying as a result of the Federal Reserve's artificial buying power. The Fed, on the other hand, has been buying bonds for months, and this isn't a new factor in the bond market. The Fed's purchasing power has remained constant throughout this time, as seen by the fact that even when bond yields soared in March, the Fed's purchasing power remained unchanged. In fact, the Fed intends to sell some of the corporate bonds and corporate bond ETFs it bought during the pandemic. Cathie Wood, like every other economist, expected the bond market to fall after the high inflation figures. Bonds, on the other hand, have continued to rally.
But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected, I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been. And so the bond market is sniffing something out, I believe. Now, many will say, well, it's just quantitative easing. And I think quantitative easing was true at the beginning of this year and through March when we went from 0.9 to 1.74. So nothing's changed on that score. But the bond market is sniffing out something here.
As ridiculous as it may appear, Cathie Wood expects inflation to continue for the next few months. Prices jumped 1.6% year over year in February to 3.9% in May, according to the Personal Consumption Expenditures Price Index. However, Cathie believes that inflation might reach 5%, so while inflation may heat up for the time being, Cathie expects prices to fall over the following few months. Ironically, the spike in oil prices is preparing the stage for deflation. The Organization of Petroleum Exporting Countries, a group of numerous countries that control oil supply, is determined to recover some revenues by keeping the oil supply low. This may seem counterintuitive, but as oil costs have risen, more consumers have begun to shift to electric vehicles. EV sales have surged disproportionately to fossil fuel vehicles during the pandemic. This is motivated by rising gas prices, as well as the notion that electric vehicles are preferable to gas-powered automobiles. If oil prices continue to rise, more people will be encouraged to buy electric vehicles, reducing the long-term demand for oil. Crude oil is now trading at around $75 per barrel, close to the previous high of $77. Cathie believes that oil will eventually fall to between $3 to $12 per barrel. Yes, you heard it right. $3 to $12 per barrel would represent an 84% drop from current prices, implying significant deflation if these low prices come into reality.
One of the reasons is, of course, OPEC, and they have about 5 million spare barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. When they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view, we haven't done the research to get us here yet, but I think we could go back down to where oil prices landed after the cartel took over in the early 70s. And they went from, I think, $3 a barrel or $4 to $12 a barrel. I wouldn't be surprised ultimately to see us back there, especially as electric vehicles continue to take off, and they are starting to take significant share.
The purchasing power of the US dollar is another piece of evidence that points to deflation. The dollar index has risen dramatically in the past months. This is in direct contrast to the dollar's fear of inflation. The fact that the dollar is gaining purchasing power against other currencies could be due to President Biden's corporate and capital gains taxes being lower than anticipated. Moreover, commodities have been dropping recently, with lumber prices in particular taking a sharp downward turn, which Cathie Wood predicted before the crash. Consumer demand is the final factor. Real consumption is down 0.4% month over month, with durable goods consumption down 4.3% and non-durable goods consumption down 0.5%. Services consumption, on the other hand, is only up 0.4% month over month, which is not quite as high as the drop in goods consumption. Overall, as seen by the collapse in commodity prices and the slowdown in money supply growth, inflation may not be a big concern as what we think or imagine. There are several opposing views on the other side of the issue, such as Ray Dalio's demand for the bond bubble to burst and Michael Burry's prediction of hyperinflation. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, please don't forget to hit the notification bell. See you next time!